Legal frameworks, education, standardization, those are the next steps.
You can't even have this conversation if you don't have proper technology in place to facilitate it. It just doesn't make sense.
Hello and welcome to Trade Finance Talks. I'm Dipesh Patel, editor at Trade Finance Global.
And I'm Tod Burwell, the president and CEO of BAFT.
Welcome to Trade Finance Talks, your go-to trade, treasury and payments podcast, brought to you by TFG. Today, we're delving deep into the supply chain, trying to understand and address some of the gaps that really can help to promote financial stability, risk management, and sustainability. And it's often the tier 2, 3, 4, and 5 suppliers that get left out. They're often the suppliers of suppliers who struggle to access that all-needed trade and supply chain finance. Since visibility into deep-tier supply chains is so difficult, BAFT and the Asian Development Bank have recently released the white paper, Deep-Tier Supply Chain Finance, Unlocking the Potential, to really try and uncover some of the more opaque aspects of this industry. Luckily, I'm today joined by Tod Burwell, President and CEO of BAFT, to help us answer some of these questions and join the dots. Tod, welcome to Trade Finance Talks.
Thanks, Dipesh. It's good to chat with you again.
Thank you and welcome back. So, quick introduction. Who are you? Where are you from? And what do you do? And tell us a little bit about BAFT.
I'm Tod Burwell, the president and CEO of BAFT. I've got a little more than 35 years experience in the cash and trade business. I spent about 5 years in logistics and supply chain management. And I've been the CEO of BAFT now for 12 years. What we do is we are an international transaction banking industry association. So we promote thought leadership and best practices. We provide policy advocacy and education and training on behalf of the industry. And so we try to help the industry as a whole by convening the industry as a whole.
Thank you very much. And as always, Trade Finance Global are always delighted to partner, collaborate and support BAFT on many initiatives. And you mentioned 12 years experience specifically at BAFT. I mean, it's funny because 12 years ago, we probably would be talking about the development of supply chain finance and how it differs from traditional trade finance. I actually want to ask you a question about deep tier supply chain finance versus traditional supply chain finance. What's the difference? Can you explain that?
Actually, and I have to give credit to the Asian Development Bank for really raising this topic. About 2 years ago, they published a white paper, and I had the opportunity to speak with several of the companies that were involved in doing deals as part of a panel discussion. And what we, I think, learned was that this was a variation on some traditional forms of supply chain finance that had the potential to reach small and medium-sized enterprises or micro enterprises that are further down the chain, that traditional supply chain finance techniques were not currently benefiting. If we go back to 2016, give or take, and BAFT is part of the Global Supply Chain Finance Forum, along with 5 other industry bodies, we put together a compendium of definitions for supply chain finance techniques. And one of those was payables finance. As we started to look more closely at deep tier supply chain finance, one of the things that we thought we needed to do was to really tighten up the definitions for what is deep tier supply chain finance and what is it not. And so you'll see in our paper, we've kind of narrowly defined deep tier supply chain finance to be a form of that payables finance technique. And it's got a few core elements. One is it's got to be related to trade finance. The second, and perhaps the most important, is it is predicated on the irrevocable payment obligation of the buyer. So it's really an anchor buyer-led structure. We have defined it to be post-shipment. And again, it's driven by the anchor buyer's supply chain. So now, when you just say that, it sounds like payables finance, right? So what's different from payables finance? Well, what's different is that, as you alluded to, the tier one suppliers typically were the main beneficiaries of a payables finance structure. What deep tier supply chain finance allows for is that original receivable to be discounted essentially in parts at multiple levels, with the benefits of that transferring down the chain. Now, I think, again, there are various forms of financing that exist in the market. There are many banks that will tell you that they're providing deep tier finance, which they may call microfinance. But we wanted to distinguish this from microfinance because we want to maintain the integrity of that initial credit risk associated with the first receivable that's created. As you go down the levels in a deep tier supply chain finance structure, you still maintain that original risk profile associated with the anchor buyer. And that's what I think is key to this.
It's a form of payables finance. It's got to be related to trade finance, predicated on the irrevocable payment undertaking of that anchor buyer. It's got to be post-shipment, and effectively it's the fragmentation of that original receivable. I mean, Tod, can we just break down a little bit more? How practically would that work, and how would that ultimately benefit that tier 2, tier 3, tier 4 supplier?
I'd like you to think of this almost as if you were looping a process. So, in the sense that you have an initial invoice that is presented from a tier one supplier to an anchor buyer, and it is approved, and you now have an approved payable, that tier one supplier has the ability to now discount that if they so choose. So in a deep tier structure, in effect, your tier two supplier who has presented an invoice to your tier one supplier also now gets the ability to discount that invoice. And the tier three supplier that's presented an invoice to the tier two supplier, so on and so forth down the line. The way that it works, and this is where the creativity comes in, maybe through a variety of legal structures, and we can talk about a couple of the structures, but I think the benefits of being able to do this, there's benefits on all parties. So from a buyer standpoint, the key is that you're creating greater resilience and transparency in your supply chain, because now you are extending benefits throughout your supply chain. And you're also creating visibility all the way down the chain. This will be also an opportunity to link ESG reporting, because once you've got the connectivity down through the deep levels of your supply chain, you can then also attach reporting to that to be able to consolidate ESG reporting. And in principle, because as a buyer, since you're creating value for your lower level suppliers, you can potentially reduce your costs as well as potential frauds. Now, on the seller side, again, similar to traditional payables finance, you've got better access to financing based on lower rates that are driven by the anchor buyer's credit rating. So if you then, again, extend that deeper down the chain, sellers at each level are getting better access to financing at better rates. And it just creates more efficient operations for them, which also can help lower their costs. And as we see more and more ESG creeping into the structure of supply chains, it also enables these lower tiered suppliers to achieve compliance and reporting requirements in the context of that supply chain. And from a financier's point of view, many of them are currently not financing SMEs or MSMEs. So this is a way for them to expand their ecosystem, and their natural client base can potentially grow because they've also now got visibility to what's happening with some of these deeper tier suppliers. And it also, through some of the technology tools, can help the onboarding of suppliers. And we've seen some examples where onboarding has been accelerated significantly. So I think there's benefits across the board.
Thank you very much. I mean, it's kind of the holy trinity of supply chain finance or payables finance, as we call it often, a win-win-win for buyers, sellers, and financiers, which you've articulated well. It's not just the buyer-led payables or the buyers that kind of win out of this. Tod, what are the challenges when it comes to actually implementing deep tier supply chain finance? And perhaps you could talk about some of those legal challenges. Are there other currency or FX considerations or operational considerations?
I think all of those. So if you start with supply chain finance by itself, there are still many markets where supply chain finance has not flourished, and largely because there's not a proper secured financing infrastructure within the country. So there are different levels of readiness just to begin with on the basis of supply chain finance. But as it relates to deep tier, there has not been one singular legal structure or legal framework. And that's part of what I think the challenges are right now we're trying to address. But in essence, you have to, within the country and within the context of that supply chain, is you have to be able to apply the structure of the payment obligation and how the financing is divided and transferred or assigned in the context of that particular legal framework. And that includes addressing all of the required dispute mechanisms. You have to address whatever the local KYC and AML and other regulatory requirements are. And because there's such variation in legal frameworks as well as these regulatory frameworks, it's very difficult to deploy this cross-border currently. Not that it can't be done, but that's one of the biggest challenges to being able to scale this up. And I think that's going to be one of our goals in the next phase of looking at this. You also mentioned operational and currency impediments, and those exist as well. If you think about tier one suppliers, oftentimes deal in major tradable currencies. But when you get further and further downstream, more than likely, those suppliers are working with localized currencies. And in some cases, those currencies may be subject to very tight foreign currency or FX control regimes in those countries. So it also can make cross-border deep tier supply chain finance a little bit more tricky if you get into currency variations. And then operationally, it's interesting because you're really dependent on everyone in the entire supply chain to be open to working with everyone else in the supply chain to provide that transparency. So you start with the anchor buyer, and oftentimes the anchor buyer has to drive it. But if you're the tier one supplier, you need to be willing to open up information about your own supply chain to your buyer. And that sometimes can be a hurdle to just get over that. You also need to be able to facilitate the onboarding of your downstream suppliers and the anchor buyers tier two and the anchor buyers tier three. Each of those have to sort of work together. So operationally, you have to have willing parties. And in addition to that, you have to be willing to pass on the benefits of discounting the payment undertaking further down the chain. In some cases, you may just want to keep the benefits for yourself. So the big challenge, I think, is just having willing participants and then having each of those layers practically engage in the process. What we've seen in a couple of examples that I've looked at is based on the life cycle of the actual supply chain, the value and the usefulness of discounting that portion of the receivable gets smaller the closer you get to maturity. So if your supply chain has a very short life cycle, deep tier supply chain finance may not make sense.
Hey, enjoying this podcast? Hit that follow button for more. Done? Let's get back to it. It sounds like it really does need to be a collaborative effort and perhaps addressing ESG, compliance, realizing those cost savings, understanding that you're building resiliency in your supply chain. I guess that's what those are potentially some of the benefits. And obviously, the other challenges really do come down to the nuances of expanding into other markets and the challenges faced there. Could tech help facilitate the effective implementation? And what are the barriers? What are the opportunities?
From our perspective, you can't even have this conversation if you don't have proper technology in place to facilitate it. It just doesn't make sense. And that, of course, is still emerging in some markets. But we have seen that there are several fintech companies that are offering solutions, and some of them may be blockchain based, some of them may not be blockchain based. But I think what's key is that there are a growing number of these platforms, which is promising. Now, fintechs, and if you think again, even in a traditional supply chain finance context, fintechs typically don't have the balance sheet to be able to do this on their own. So their role is really to be the technology enabler in this. And they oftentimes will partner with banks or other lenders. And we've seen a few different examples of that. So I think we'll continue to see opportunities for fintechs to expand their partnerships with banks in different markets. And that may help to sort of spread the coverage of where these models can be used.
Thanks, Todd. Do you have any examples or case studies, since this concept has really been in place for a good few years now? How has DTSCF been successfully implemented? And are there any lessons that we can learn from these experiences?
I want to be careful not to use names. I don't want to upset anyone that I may miss and show any favoritism, but we've certainly seen some case studies. Most of what we've seen has been successful in China, but there are examples in other jurisdictions as well. There was one particularly in China that we saw that was able to reach 9 levels down in the supply chain, which is pretty amazing when you think about it. This structure, they were able to get to, over $70 billion in the course of a few years. And in that particular structure, the average invoice was only about $77,000. In fact, the smallest invoice that we came across was as small as $15. It's unthinkable when you think about scale, because from a financier's perspective, you're typically not going to be interested in a deal if the ticket sizes are really small. Again, the point to this is if you're providing value at an SME and a MSME level, you're going to have smaller and smaller ticket sizes. So if it can work for a $15 invoice, then it can work, right? We saw another example on a blockchain-based platform where I think the bank had about 1,000 suppliers that were on the platform, and they were able to reduce the onboarding time by 75%. Now, if you think about what's been holding supply chain finance back from scaling, many people will tell you it's just the onboarding of suppliers. Having the right technology and the structure where each of the tiers are onboarding their own supplier networks, if you can reduce your onboarding time by 75%, you've got something. And that needs to be looked at more closely to see, can it be replicated in other scenarios. We have seen a couple of instances where a bank using one of these platforms was able to combine a deep tier structure with other financing structures that they used. And so if you recall, I said the deep tier structure, as we defined it, was a post-shipment structure. There have been instances of combining that with pre-shipment structures so that the bank was able to provide truly end-to-end structures. We also saw a bank that was a completely digital bank that had incorporated deep tier supply chain finance into their suite of digital offerings. And it's pretty impressive because this digital bank has 10 million SMEs on a digital supply chain finance platform. They've been able to increase the approval rate for SME lending from 30% to 80%. They've got about, of those 10 million suppliers, 420,000 of them that are quote unquote green enabled, as I alluded to the ESG components of this. So there are bespoke examples of where there are really tangible benefits. And I think that's why we're so interested and excited about the possibilities of this. But we still do have a lot of work to try to get this to scale.
Some really good examples and actual stats. I guess the next step, as we also discussed for supply chain finance, which is how do we scale this? What are the next steps for stakeholders? And perhaps, we could even start with BAFT's own members. What can banks do to get involved? And how do we really help them realize the potential of deep tier supply chain finance as a bit of a win-win-win for everyone?
The first thing, like everything else, is to start with education. And both BAFT as well as the Asian Development Bank have been trying to engage in as many conferences, webinars, panel discussions, etc., to talk about the structures, what the benefits are, why organizations ought to take a look at this, because the more that organizations know, then the more they can use it, but also the more those organizations can innovate and add to the structures that are out there. So I think that's the first thing. The second thing, which I would like to do, is we've seen this work in certain markets. And in many cases, it's where there's a strong domestic supply chain. I think there may be other markets that have strong domestic supply chains where this could potentially be deployed. And so without reinventing what the structures look like, it might just be trying to take this to other markets where the legal frameworks can support deployment. And then I think the heavy lifting is going to come in with trying to address legal frameworks and consistencies that will enable this on a cross-border basis. And so some of the legal structures we've seen are based on contract rights structures with irrevocable payment undertakings. Some of these are based on negotiable instruments. The lawyers in our working group think that the North Star ultimately is to get to a token-based structure. But obviously, there are not many jurisdictions that are ready for tokenization and things like that. The heavy lifting for us is going to be looking at the legal frameworks and see how we can better enable cross-border legal frameworks. And then once we can do that, it will be to try to standardize some of the client agreements, standardize some of the onboarding processes and things like that so that scale can be achieved.
Legal frameworks, education, standardization, those are the next steps. And I guess, as always, as we always say to our listeners, read the white paper for more information. It's very much readily available. It's called Deep Tier Supply Chain Finance, Unlocking the Potential, released just last month in May 2024. Tod Burwell, it's been such a pleasure having you on Trade Finance Talks. Thank you very much and see you soon.
Thanks as always. Look forward to seeing you.